Did you know that missing out on the 10 best days in the stock market over the past 20 years could have cut your returns in half? That's right, just 10 days. This startling statistic highlights the crucial role timing plays in investment success. It's not just about picking the right stocks, it's about knowing when to buy and sell. We've all been there. You buy a stock, it goes up and you're thrilled. But then, it starts to dip. Do you hold on, hoping for a rebound, or do you sell, fearing a further decline? Timing your exit strategy is just as critical as your entry point. The truth is, there's no magic formula to guarantee perfect timing. But understanding the factors at play and developing a sound strategy can significantly improve your chances of success. In the following sections, we'll delve into the art of selling high and equip you with the knowledge to navigate the exciting world of stock market investments. Fasten your seatbelts, it's going to be a wild ride. Many investors wrestle with the age-old debate. Is it better to time the market, trying to buy low and sell high, or simply stay invested for the long haul? The answer, like most things in finance, is not so simple. Timing the market perfectly is incredibly difficult, even for seasoned professionals. It requires predicting short-term price swings, which are often influenced by unpredictable factors like news events and investor sentiment. Trying to outsmart the market in this way can be a recipe for frustration and ultimately lower returns. On the other hand, time in the market allows your investments to compound over time, benefiting from the long-term upward trajectory of the stock market. Think of it like planting a tree. The earlier you plant it, the more time it has to grow and flourish. So what's the verdict? While trying to time the market perfectly is a fool's errand, understanding market cycles and trends can inform your selling decisions. It's about finding the sweet spot between being too active and too passive, a balance we'll explore further. Emotions are powerful drivers of human behavior, and nowhere is this more evident than in the stock market. Fear and greed in particular can cloud our judgment and lead to irrational investment decisions. When markets are soaring, greed takes over. Everyone wants in on the action, driving prices higher and higher, often beyond reasonable valuations. This euphoria can be intoxicating, leading investors to hold on to stocks for too long, hoping for even bigger gains. But what goes up must come down. When the market inevitably corrects, fear sets in. Investors panic, selling their holdings to avoid further losses, often at the worst possible time. This fear-driven selling can create a self-fulfilling prophecy, pushing prices down further and further. The key to successful investing is to recognize these emotional biases within yourself and develop strategies to mitigate their impact. Don't let fear or greed dictate your investment decisions. The stock market is like a giant puzzle with countless pieces influencing its movements. Understanding these factors is crucial for making informed selling decisions. One key indicator is overall market trends. Is the market in a bull phase characterized by optimism and rising prices, or a bear market marked by pessimism and declining values? Recognizing these broader trends can provide valuable context for your individual stock picks. Another important factor is interest rates. When interest rates rise, borrowing becomes more expensive, potentially slowing down economic growth. This can impact corporate profits and consequently stock prices. Economic data also plays a role. Keep an eye on indicators like GDP growth, inflation, and unemployment, as these can signal the overall health of the economy and influence market sentiment. By carefully analyzing these market whispers, you can gain valuable insights to inform your selling decisions. Section 5, the Company Report Card, your guide to success. While understanding the broader market is essential, never lose sight of the individual companies you're invested in. Their performance is the ultimate driver of your investment returns. Think of a company's quarterly earnings reports as its report card. Are they meeting or exceeding analysts' expectations? Is their revenue growing? Are they maintaining a healthy profit margin? Positive answers to these questions suggest a company is on the right track. Pay attention to a company's management team. Are they experienced and trustworthy? Do they have a clear vision for the future? Strong leadership is crucial for navigating challenges and capitalizing on opportunities. Finally, consider the competitive landscape. Is the company facing increasing competition or disruptive new entrants? Or are they maintaining a strong market position? Understanding these dynamics is essential for assessing a company's long-term prospects. Section 6. Your Financial North Star. Your personal financial goals should serve as your guiding star when making investment decisions, including when to sell. What are you saving for? Retirement? A down payment on a house? Your child's education? Your investment time frame should align with your goals. If you're saving for retirement decades from now, you have a longer time horizon and can ride out short-term market fluctuations. But if you need the money sooner, your risk tolerance might be lower. Consider your risk tolerance. Are you comfortable with the ups and downs of the stock market, or do you prefer more stable investments? Your risk appetite should influence your selling decisions. By aligning your investment strategy with your personal financial goals and risk tolerance, you'll be well positioned to make sound selling decisions. Section 7. The Art of Selling High Strategies for Success. Now that we've covered the factors influencing selling decisions, let's explore some practical strategies for timing your exits. One approach is setting a target price. Determine a price at which you'd be happy to sell, based on your investment thesis and the company's fundamentals. When the stock hits that price, it's time to cash in some profits. Another strategy is trailing stops. This involves setting a stop-loss order at a certain percentage below the stock's recent high. As the stock price rises, you adjust your stop-loss upward, locking in profits while allowing for further upside potential. Diversification is your friend. Don't put all your eggs in one basket. By spreading your investments across different asset classes, sectors, and geographies, you can reduce your risk and potentially enhance returns. Remember, selling is not a sign of failure. It's a natural part of the investment cycle. By developing a sound selling strategy and sticking to it, you'll be well positioned to achieve your financial goals. Section 8. The Wisdom of the Oracle of Omaha. No discussion about investing would be complete without mentioning Warren Buffett, the legendary investor and CEO of Berkshire Hathaway. Buffett's investment philosophy, characterized by a long-term perspective and a focus on value investing, has earned him billions and inspired countless investors worldwide. One of Buffett's most famous quotes is, "Be fearful when others are greedy and greedy when others are fearful." This simple yet profound statement highlights the importance of contrarian thinking in investing. When everyone is rushing to buy a particular stock or asset class, it's often a sign that it's overvalued. Conversely, when panic selling takes hold, it can create buying opportunities for savvy investors. Buffett also emphasizes the importance of investing in businesses you understand. He believes investors should focus on companies with strong competitive advantages, competent management teams, and a history of generating consistent profits. By heeding the wisdom of the Oracle of Omaha, you can develop a sound investment approach that will serve you well throughout your investing journey. Section 9. Your Journey to Financial Freedom. Investing in the stock market can be a wild ride, full of ups and downs. But by understanding the factors that influence market movements, developing a sound investment strategy, and maintaining a long-term perspective, you can navigate the challenges and reap the rewards. Remember, there's no magic formula for timing the market perfectly. Instead, focus on making informed decisions based on your personal financial goals, risk tolerance, and careful analysis of the companies you invest in. Don't be afraid to seek out knowledge and learn from experienced investors. There are countless resources available, from books and articles to podcasts and online courses. Investing is a journey, not a destination. Embrace the learning process, stay disciplined, and never stop striving to improve your investment skills. The rewards will be well worth the effort.